All right. So the third week. Yeah, I'm not going to do the live broadcast this week because I'm getting all kinds of emails about the homework. People are really spun up about trying to figure out which version of the book. As I stated in the lectures, but I'm not quite sure how many people actually watching. But that's neither here nor there. The homework is turned in as a batch before the midterm. For some of you people who may not even have gotten the textbook yet or whatever, I always realize there's logistical delays sometimes in getting that done. The reason I structure it like that is to, make it a little bit more of a controlled start to the semester. And also, since this is a, distance asynchronous course, people typically take that because they will apply the time to this course, but they can't always do it on the set schedule. So anyway, let me just step right into the homework stuff. So the problem is that I allow different editions of the textbook, and so sometimes the problems end up on different pages. Not a big deal, and we go through it at some point, but obviously based upon the email traffic, I'll go through it now just to kind of resolve the situation as quickly as possible. So anyway, what you're looking for, these are not the complete problems. Obviously the answers on here aren't on here either, but these are the problems that are going to be assigned between now and the first midterm. So what you're looking for when you say, oh, it's not exactly, page whatever, problem's not on this page. If it starts with this sort of text, you figure out what page it is in the textbook. It'll take a little bit of work on your part, but the alternative is, I guess I could insist on everybody have the brand new edition on the textbook, and it can be a little pricey for the more cost conscious folks amongst you. You can get this textbook for quite inexpensive, and the editions, I don't know if you all realize in terms of professors and publishing textbooks, but it's kind of it's a side hustle for a lot of these folks because they come out with a new edition, they change a word or two, they claim they've been published again, and it just kind of saddles the students with a lot of extra costs. So I'm trying not to support the whatever big textbook, I guess it is in this case. But anyway, so the problems that you need to do are as follows, as laid out on the last page of the exam, and you complete them and you turn it all in as one batch assignment in whatever format you want. I mean, I get pictures, screenshots, taken with your iPhone or whatever. It matters not to me. PDF, JPEGs, whatever. And sometimes it's better done by hand. The point is that you do and understand the homework, the format again. It's the rest of the stuff. If you kind of let technology get in the way, it kind of disturbs things. So for today, we're going to talk a lot about taxes. I will publish this thing out there. I'll put it out there on the Blackboard page. Usually I do it a few weeks into the term, but anyway, this time I'll do it a little bit quicker. But tonight we're going to move around and talk a lot about taxes and stuff, and so it's better not to have this one live anyway, because sometimes there's glitches. I'll be referencing some things off the internet, TurboTax and stuff like that, and it can sometimes get to be a mess if I can't pause it and get the screens right and all that. So okay, so the three components, obviously every week there'll be the published text lecture just in a PowerPoint format. There'll be the video lecture. Then there'll be, the homework, but again, it's not turned in weekly. And then lastly will be the video for comment. So tax concepts. So, earning money is great, but I don't think I'm exaggerating that holding on to the money is much more difficult. Things are structured, again, to whatever. Unfortunately, a lot of things are structured not necessarily at the retail consumer level, Some of the tax breaks don't necessarily apply. So you have to be smart on taxes to make sure you take advantage of what you can. The concept of taxes itself, I mean, it is based upon fairness in terms of paying for services that you're delivered to a certain extent. But if you really explore taxes to the full extent, you'll realize that pretty invasive and pretty much set to kind of manipulate you into behavior that is in accordance with the government. Sometimes that's good, sometimes it's bad. I mean, there are certain things that are great in terms of motivational sort of tax breaks, tax credits. We'll talk about deductible and tax credits, two different things. But anyway, there are tax credits, say, for insulating your home. There's tax credits for, certain vehicles and stuff. And those, for the most part, are pretty good. Things that are, outstanding by any stretch are adoption credits for people who do that, because there's a lot of legal expenses involved and things to streamline that and incentivize it and help society. All that stuff's good. And then roads and bridges, the rest of it, that's all fine. There's some other stuff that obviously not. Special taxes, sometimes we'll call these things sin taxes. Alcohol, cigarettes, gasoline. Gasoline is probably not necessarily a sin, at least in most people's minds. Alcohol and cigarettes, though, yeah, these people really don't have an advocate. It's that's the problem. If you are some of the most beneficial tax breaks go to people who hold real estate, for whether it be a homeowner or whatever, because that lobby is super strong, and also it is good for society to have some stability with people, owning their homes and things like that. But something like alcohol and cigarettes, obviously, those taxes are fairly confiscatory, as they should be, because they're deemed as social ills. Unfortunately, a lot of times, though, the amount of money they collect is not as significant. Like, a lot of things are based upon cigarette taxes, and the fact that people don't smoke anymore, or to a lesser extent, means that you have programs that are established that are now no longer funded and have to be drawn from the general fund. But anyway, corporations are entities, right? Corporations have personhood. Again, semi-controversial, but you can sue a corporation in court. Corporations can pay taxes and do pay taxes. Problem is if corporations pay taxes and then they give the money to their shareholders or the owners of the corporation, then they're taxed again. So that can result in double tax. Well, will result in double taxation. So anyway, corporate taxes are what they are. Some people think they should be higher or lower, but a lot of those arguments are based on the fact that it does represent a double taxation. Property taxes, certainly, primarily they say to fund schools and things like that, done at the local level. Typically, sometimes it can also be done at the state level. Government service and programs, and you pay taxes generally at just about. In Alaska, it's an unusual state in that the state taxes are not as significant, although there are some. And then local levels, typically a sales tax, property tax, those types of things. But you also see that, there's a lot of those. We already talked about the sin taxes, but there's also a lot of other taxes that sort of sneak in. When you go to the DMV and pay to register your car, is that a tax? It could be argued it is. And then also, there's two different concepts when you're talking about taxes. You have progressive taxes and regressive taxes. Progressive taxes are what our tax system claims to be, where if you're struggling, if you're making less than, say, 10 grand, you're not going to be taxed. In fact, you're going to be getting money back. And if you're making $1 million, you're taxed at a higher rate. So that is progressive. It's not only does the millionaire pay more taxes, but as a percentage pays more. But regressive taxes, that's kind of the natural order of things. And when things are left alone, they sort of sneak in there. It could be argued that people with less wealth are generally the ones who who smoke, generally the ones who do a lot of the behavior that could potentially be taxed. Also, there's just other regressive taxes. If you're driving down the Glen and you get a ticket, $100. If you're a millionaire, yeah, $100 isn't a whole lot of money to you. If you're, just commuting to your Walmart greeter job, $100 is going to leave a mark. So again, are speeding fines taxes? Maybe, if they're issued with a frequency and rapidity that means they're just sort of a cost of doing business sometimes. Taxes paid in several ways. So transactional taxes, payroll withholding, and quarterly payments. So quarterly payments, that just means that you're normally going to owe taxes, and the IRS, they aren't in the business of giving you a loan. If you're going to owe one money at the end of the year and it's going to be a significant amount, they're going to put you up on quarterly payments where they want you to pay your taxes. You always pay your taxes in arrears, meaning that as we're coming into tax season right now, we're coming into, we're in 2024, but you're paying taxes on 2023. You'll normally pay them on April 15th is the deadline, unless you file something. But even if you file an extension and you owe them money, well, then they'll want a little bit interest on that money because they consider that money theirs, the IRS does, from the time that it's taken. Americans, for the most part, are fairly honest with their taxes. In fact, they live in fear of the IRS, and so they tend to overpay. In other nations, having lived in Europe a bunch, man, they don't trust people one bit. And people generally, if left to file their taxes, it just doesn't happen. I still pay some taxes in Germany on some property I have over there, and it's a kind of a clunky system because they get their money through what they call a VAT, a value-added tax, which is sort of a sales tax on steroids. But if you go to Germany or Europe, anywhere in the EU, you think, oh, they don't have sales tax here because it's not added on to the price. It's included in the price. And it's pretty high. It's about 20%. So when you go in there to buy something in the store, be it groceries or whatever, you see a price tag of 100 euros. About 20 euros of that is already taxes. And every time the product changes hands, when it goes from the distributor to the to the retailer, 20%. So that's how they get their tax in Europe. And it's a little cleaner system for them because they don't spend as much time trying to collect the taxes because they do have, extensive government programs. And so they do have fund their government quite lavishly, but they do it, you could argue, kind of insidiously through the value-added tax. But I also know from having projects over there where I've never, without exception, had a guy show up to my house when I was living there to work on something, to build something, and the question would always be, do you need a receipt? If you didn't need a receipt, it was 20% cheaper because they weren't going to claim the VAT. They weren't even going to claim that job happened. And the workers who were working for them were generally, on the dole. They were claiming unemployment yet working at the same time. So it's a at least the Europeans, they realize what they're up against, and they do it all, just about all of it in a value-added tax because it's very hard to escape that one other than with the services like I was talking about, where the contractors will plumbers and roofers and guys like that will not charge it. Income tax ends the previous year and need to be filed by April 15th. So again, if you wanted to change something regarding your taxes from 2023, the tax you're going to file, you're kind of stuck. You might be able to deduct an IRA, put some more money into that or something, but in terms of selling some stock or selling an asset or doing something, getting married, getting unmarried, none of that's going to affect it if it happened after December 31st. Social Security, Medicare taxes, you know, some people are under the illusion there's a lockbox out there with your name on it, with your Social Security money. Yeah, not happening. Medicare taxes, again, another tax. Again, these are supposed to be designated for the certain programs, but it doesn't always work out that way. Social Security, for example, there's numerous lawyers. There used to be some real famous guys. They were on late night TV, and guys with their cowboy hats, and what they were doing was they would get people who were on disability at the local state level, and they would encourage you and help you and do all the programs to get you on Social Security disability, because Social Security disability is a federal program, takes the burden off the local government. And so you, as the recipient of this money, they didn't even charge you a fee. They got paid by the state. The state would, at the time, was paying $1,500 for every person that they could convert to a federal program, get them off the state thing. So it's, there's lots of different incentives. But my point is that with Social Security, if you put a lot of extra burdens on Social Security and you raid the Social Security fund for other programs other than to fund Social Security, it's going to be insolvent, which it is. And it's also a bit of a Ponzi scheme, because Social Security depends, the workers pay into it in concept, and they fund the people who are currently retired age. Well, the generations are slightly different in that the baby boomers are in retirement, big generation, and the people paying into it are a smaller generation. So it's I wouldn't say doomed, but it's not going to do well. Medicare taxes, we know what's happened to medical expenses, so those are going to go up as well. So anyway, there's a lot of taxes to be paid. These are just old numbers, but what happens with Social Security, you can actually get to a point where you are funded in your Social Security. Medicare 1.5, and then self-employment, yes. If you're self-employed, you should also be withholding those amounts. Different taxes, done on different forms. Obviously, 1040 easy. The complexity of the form, these are getting simpler as we go along. 1048 is the normal one, or 1040 is the normal one, 1048, and then 1040 easy. But what the IRS would, like you to do is just pay your taxes and kind of forget about it. If you want to make deductions, if you want to pay perhaps less in taxes, you would have to file the more complex form. But they're perfectly happy for you to file the 1040 easy. And in certain cases, it does make sense, in most cases. But if you're a homeowner, if you have investments, if you have the rest of that, a small business, then you're going to be pushed into one of the other forms. If you're doing this online, whatever form is fairly transparent to you, so it doesn't really matter. There's a misconception where people think, oh man, I got a great refund, I'm really doing well, no. What that means is you overpaid your taxes throughout the year. You gave a loan to the government, which they're all about that. They don't want you owing them money, but if you want to overpay your taxes each year and then get a refund back, they're more than happy to sit on your money for whatever number of months that takes. If you're consistently getting a huge refund, you probably need to adjust your withholdings. You do need to adjust your withholdings, because what happens is through the course of the year, amounts are withheld from your paychecks or your investments to cover the subsequent taxes that are going to be done at the end of the year. But it's more an estimate. You don't actually settle up until you fill out your taxes. And so if you owe money and it's a reasonable amount, everything's fine. If you owe a bunch of money, they're going to be assessing you penalties. They're going to make sure you start paying quarterly. They're going to make sure that you don't owe them a lot of money the following year. If they owe you a bunch of money, nothing will be said. Kind of a gloomy chart here, but you can see by just the blocks. So income tax is where about 50% of it's coming. a little bit in the way of corporate tax, payroll taxes, so those other things, the Medicare, Social Security, excise taxes, and then other taxes, but a lot of taxes. And this gets back to the progressive nature of how this works. So again, these numbers are getting dated, but the top income, from throughout time have paid more. In fact, it was ramping up a little bit. So and that has to do with the progressive nature and tax brackets. We'll explain tax brackets here in a second. Minimum wage, kind of a joke. Minimum wage, if it were actually what it kept pace, it would be in the $30 an hour thing. But whatever. There's a lot of downward pressure on wages. It's a supply and demand feature, and with open immigration, with AI, with the ability to telework from other places. A lot of people thought, oh, this is going to be great. I'll be able to work at home. Well, people from other nations can also work at home, and so anyway, it's going to be tough to have wages go up based upon supply and demand, given the fact that supply is outstripping demand. So the wealth disparity, the income inequality, that's probably not going to change anytime soon. Filing status. So when you go to file your taxes, you have different options. Obviously, you want to go in the most fortuitous, filing status you can. You don't want to claim single unless you are truly single. If you're married, you pay a little bit less in taxes because there's two income earners. Now, there's certain situations where you can be married and you can, run your taxes. And again, this is where it helps to run your taxes before the end of the year, so that you can maybe change your filing status or maybe change your marital status. I mean, there have been points, it's not necessarily occurring right now, but certain times where people, based on the tax code, would literally get divorced once a year, because if you're single a certain part of the year, you can claim that. Now that the tax code is written as such that it favors people being married. So most people, if they are married, will file jointly. But there are certain occasions where, say, somebody's a doctor and somebody's, just doing a little side hustle gig, and the disparity of the incomes, it may make sense to file separately. Typically not the case anymore. Head of household it's been around for forever, and it's recognizes that a lot of times a single person may have dependents, may have children, may have, in certain cases, elderly that are dependent upon them. Well, it's fair that they get some recognition for taking care of their dependents, and they can claim head of household status, which will reduce their taxes. And qualifying widow, whatever, will, if they have children, will also have a different category, because, again, that's kind of outside of your control, and it's not necessarily a nice thing to jump on somebody who's had a tragic thing, at least for a couple of years. So they'll allow a modified filing status. This is the 1040. Again, it's fairly daunting. You could fill it out by hand, but if you do that, you're going to kind of be wasting more time filling out paperwork than you are going to be doing your taxes. This is an old document, but don't worry, it hasn't changed a whole lot. But the fact is that if you do your taxes, you typically don't even see these if you're filing online. So, gross income is the amount of money that you're taking in, all from all sources. So everything. If you happen to be lucky enough to win something in a casino, they're gonna, and it's a large amount, they're going to give you a 1099-G, a form that shows that as income. If you win one of the, draws, some sort of lottery, you're going to get that's all counted in as income. So, it's not just wages, interest income, dividend income, so from your investments, capital gains, meaning, you sold something for more than you paid for it, and the rest of it. So, as I talked about last week, short-term versus long-term, so 12 months versus longer. So, this does make a huge difference in paying taxes. And so to flip assets, to be some sort of day trader or something, it's going to be more expensive for you come tax time because you didn't hold that asset for a year. We'll quantify that here in just a bit. Capital gains tax, yep. And I'll show those rates here in just a second. So gross income, if you're trying to hide something, this is where, the IRS is fairly emboldened. I mean, they actually have weapons and stuff now too. I mean, what happens is that you have a lot of crimes that happen out there, and sometimes it's very difficult and kind of whatever. People get shot trying to, let's say you're a big drug dealer. If you're the government, you want to stop this drug dealer. Do you want to try and get out there in the middle of some drug transaction? Or do you just want to roll up, this person's got a pallet full of cash, and the IRS basically says, where did all this money come from in terms of your tax records? Where is this income from? Well, if you can't show a source of that income, obviously that's pretty suspicious to the point where you're going to go to court and then ultimately to jail. So the tax code is pretty harsh because it's used a lot of times to fight crimes. Again, this goes back to the 30s and the mafia and stuff. If you want to catch those people, it's sometimes very difficult to catch them in the crime, but it's not hard to catch people with stacks of cash that they're forced to account for. And again, don't fool yourself, you're guilty till proven innocent with the IRS, and if you can't account for that cash, bad things are going to happen. And so that's part of the reason the code is what it is. So again, I'm not going to spend a lot of time talking about the individual forms because for the most part they should be transparent to you, because you'll be doing it on some sort of automated system. So interest, dividends, foreign accounts. Generally foreign accounts you have to have more than 10,000 in them, but short-term, long-term, so everything's going to be accounted for, and then you're going to pay the tax based upon that. So you can go through with a pencil and fill all this stuff out and go to chart this and subtract line from that, but it's in terms of your time is better spent coming up with a tax strategy rather than getting down in the weeds and mechanics of how to fill out the form. And it's not as easy to make quick revisions and run different samples. So you get your gross income, and then you're interested in finding out your AGI, your adjusted gross incomes. So this is where those deductions come from, and this is where you get into the 1040 rather than 1040 EZ or something like that. What happens is the government, the IRS says, okay, look, everybody's got some deductions. Everybody's has something that they claim that, they don't have to pay taxes for, a legitimate expense, an interest expense that might be deductible. They'll pick a number like, say, $18,000. They'll say, we're going to give you a standard deduction of $18,000. That number changes every year, but they set some figure. And you can itemize all your deductions. You can calculate your deductions, but unless they're greater than, let's say, $18,000 in this case, you're better off just taking the standard deduction. So you will do that. In order to do this process, though, you've got to go through and you've got to itemize all your deductions, and then you get to column A versus column B, and if column B is the itemized deduction, 18,000, and your deductions were like 10,000, well, you're going to go ahead and take the standard deduction. So if you just take the standard deduction, boom, your taxes are done. That was very easy. If you're going to itemize the deductions, if you know that you have mortgage interest, which, let's say you're buying a house, all that interest you're paying on that loan is tax deductible. All that property tax you're paying on your own home is tax deductible. So you're probably up at, pretty much at 18,000 already, just based upon those two amounts. So once you reach that threshold, every dollar more is going to be another deduction. So you're going to continue on that road. So standard deduction, not affected by income, affected by filing status and age, and adjusted by the IRS. So I can't, give you a number. I pulled this 18,000 number out, but what your actual number is going to depend on filing status and age. This is back in the day, so these numbers are too low. 12.6. So again, it's recognized that different filing statuses have different amounts. That's why married filing jointly, or the surviving spouse or that widower, is in better shape. Itemized deductions. So, interest on certain things. It used to be everything. It used to be consumer debt, credit card debt. No more. State income tax. This gets kind of ugly and kind of political. They call this SALT, state and local taxes. And so if you're a high tax state, say you're California and New York, who cares how much your property taxes are or your whatever taxes are, because people are going to deduct it from their federal taxes. Who gets screwed? The federal government gets screwed because they get less in the way of taxes because, Anyway, so you are going to see those numbers change back and forth depending on what administration is in. But when they limit the amount of state and local taxes you can deduct, man, people will squeal in those high tax states. If you're from a place like Alaska, you're probably on the side of the argument that says, well, if they want to have high taxes, then they should pay them. If you're one of those people in the high taxes, if you're somebody who lives in, say, California, and you're a high wealth kind of individual, your combined tax rate between your federal and your state and your locals right around 63%, which gets to be a point where maybe you're disincentivized to work much harder if you only get to keep 37% of what you make. You think your taxes are bad, Anyway, it's a rich person's problem. Local income taxes are deductible when itemizing, typically. So real estate taxes, medical expenses. Medical expenses are deductible, but you have to be pretty sick. And this is kind of sad. I mean, if you have medical expenses that are quite high, but they're paid by your insurance, well, then they're not deductible. It has to be expenses that you paid out of pocket. So if you're making $100,000 a year, you had to spend $10,000 of your own money, which isn't necessarily hard to do, but before you even can begin deducting. So if you had $11,000 in expenses, you can only deduct $1,000, which isn't much. Charitable gifts, typically 1 for 1, and then keeping receipts and records and all that. So I guess we'll talk about deductions and credits right now. What happens is deductions mean that it's deducted from your income. So let's say you make $100,000 a year and you have $10,000 worth of tax deductions. That means that your taxable income is $90,000, but you're going to still be taxed on that.
It's just, it's your taxable amount is going to go down, as opposed to a tax credit. A tax credit means that whatever you owe in taxes, say you have $1,000 tax credit, your taxes are going to go down by $1,000. I'll wait till we get to tax brackets, and I'll explain a little bit more. Other expenses, things that are stolen, job expenses if they're job related. Anyway, you can get pretty creative as long as they're legitimate expenses, but they have to be related to work in this case, and then they also have to be non-reimbursed. So you can't get paid twice on things. Anyway, here they're doing their deductions. And again, some of these computer programs are quite helpful to let you know. We're going to come back to this. I've actually got the program open, and we'll look at some of the examples. But it can be quite helpful. TurboTax is the only game in town, but they are pretty big. They're pretty useful. But again, I'm not advocating paying these people any money unless you generally want to file with them. But to run your taxes through, you don't actually pay for these services until you actually file with them. Otherwise, it's all free. Exemptions. So deducting on people, it will affect the amount of money you're going to pay on your taxes. It will, you're going to come up with a certain AGI. You're going to, have your deductions, and then you're going to claim your exemptions. And exemptions can be, typically you, your spouse, and then dependents. So AGI less deductions and expenses is the taxable income. And then you go into a chart and it says you pay this much. Now that chart is based upon your tax bracket, right? So this gets back to the progressive tax system. So you can separate, I'll call them for what they are, idiots from people who know about taxes. When somebody says, "Oh, I'm making $100,000 a year, and I don't want to make, $102,000 a year because that's going to push me into a new tax bracket. I'm going to be in the 24% tax bracket, and I don't want to pay that much more in taxes." That person fundamentally does not understand the tax code, tax brackets. They're not somebody you should be taking any advice from. They don't know the system. The way the system works is, let's say you're making $100,000. This applies to you or anybody else in this case. I mean, wherever your income stops, that's where these numbers quit being applied. So whether you're making $10,000 a year or $100,000 a year, on your first $10,000, right, or $11,600, you're going to be paying 10% taxes on that. In reality, if you're a low income guy, you're going to be getting money back, so you're not even going to be paying anything. That next increment, that money that you earn from $11,600 up to $47,000, you're going to pay 12%. So if you're making less than $50,000 a year, your maximum tax rate is only 12%, but you're only paying it on that chunk. The first chunk, the first 10,000 or so, 11,000, you're only paying 10%. The second chunk, from 11,600 to 47,150, you're paying 12%. So let's get back to the idiot example. This person who says, "Oh, I don't want to make 102,000 because I'm going to be pushed in a different tax bracket." What's going to happen is that income that you're making from 100,000, 525 to 102,000, that $1,500 or whatever, is going to be charged at 24%. Not all of your income. It's just that one little increment. So that's where, now there are government programs, Obamacare, or the Affordable Care Act, whatever you want to call it, the medical situations where they may have absolute income levels where you no longer qualify because you made more than a certain amount. They do that sometimes with deductibility of student loan debt. That can have income thresholds, but your actual taxes to be paid, no. This is how brackets work. So you can quickly, if you're ever, looking at somebody to give you some tax advice, ask them about tax brackets. If they can't explain this, then they have no business giving you advice. Here is, why you don't want to be in the single category if you can avoid it. If you're married, you can go all the way up to over 200 grand and still stay at the 22% rate. And then if you're head of household, the numbers are going to be just slightly different, but a little more fortuitous because there's one person bringing in the income here. Here there's typically two salaries. So that's how tax brackets work. To review the tax deductibility issue, let's say you're paying, you donate some money to charity, or you make a donation. You give a vehicle away to charity, and they say, oh, it's tax deductible. So you give this vehicle. Let's say the vehicle has a worth of $1,000, and they say it's tax deductible. Your tax liability is not reduced by $1,000. No, your income that's reportable is tax deductible, so it's reduced by $1,000. So in this case, if you're paying 22%, 22% in terms of taxes, by having your $1,000 income reduced, what you're doing is you're reducing your tax load by $220, right? If you make $1,000 and you're in the 22% tax bracket, you only get to keep whatever, the $800. The government takes 22% of that. Therefore, if your income is reduced by $1,000, the government does not take that 22%. If it was a tax credit, though, if it's a legitimate thing like getting back into some of the adoption expenses where there's a tax credit, and they say, oh, we'll give you a $5,000 tax credit. That means whatever you owed in taxes, let's say your amount owed comes up to $22,000 or something, your taxes to be paid would be $21,000. It's a 1-for-1. A credit is 1-to-1. Deductibility, you have to take into account your tax brackets. So for those of you who still don't quite get it, there's a video that will cover this week, and I'll make it pretty clear. Now, this is the reason why you want to go long term on capital gains. Let's say you sell some stock and you sell it at 11 months. Boom, you're paying 22%, 24%, whatever. It's counted as regular income because it's a short-term capital gain. If you keep it over a year, boom, all of a sudden it's much less, down around 15%. If you're making 400 grand a year, you're going to have to pay 20%. But for most of us, 15%. And if you're, again, not knocking it out of the park, you're not going to pay a dime. So, but taxable income. So, again, they're looking at AGI type stuff. Determine your tax liability. Yeah, it's all just magic. You go into the chart and you look on there and it tells you what you owe. Or the computer calculates it for you. So, tax credits, child tax credit, boom. Other things, yep. Sometimes 529. For example, let's say you're doing your term paper and you want to get an A on the paper, and you say, oh, I'm going to save, $100,000. I'm going to put away in a special account for my child's, college fund. you'll get it at best a B on that paper because you didn't use the 529. The 529 is specifically set aside for saving for college. If you put that money in that account and it is used for college, then it's tax-free. If you use it for something else, well, then there's a penalty, but not that significant. If you have children and you want to, there's a chance that your child's going to use it, 529 is a good idea. And there's other programs that are very, similar things, Coverdale's and Tugmas and Utmas. It depends on the state a lot of times. But some sort of tax-deferred savings plan for education is a good idea. Earned income, so this is where the person actually gets a little bit of money back, a credit. We talked about child care, adoptions. And again, back to TurboTax. We'll check in a second. These are the problems. So let's go look at this one more time. So again, your problems, the expenses, find the page, look for the number. I mean, I guess it's a little bit extra burden on you to figure this out, but you've got the clues to pull it off now. All right, let's look at TurboTax. Again, this is none of my personal information. This is just an account I've got set up, not with real numbers, but just to sort of help. So Intuit, the big company, they own TurboTax, Credit Karma, QuickBooks, they own all this stuff, right? And so they are whatever. Don't be surprised when you get a bunch of stuff to your email. Do I still work at D? D is just whatever company. Did I do anything in my life that's going to change my situation? I'm going to say no. They're asking these questions. So this is just a nicer experience than struggling and going through these forms line by line. You're going to get the same answer. It's going to spit out a form at the end. But again, it's kind of asking the right questions and kind of getting you pointed in the right direction and just a more positive experience. And it sort of guides you to focus on the things that are important. It wants to know whether you got some, whatever, had any things going to have impact on your taxes. So it's maybe not going to ask all the questions, but it's pretty thorough. I mean, this is a fairly widely produced program. Another thing they can do, now they're going to try and sell some extra services. Yeah, whatever. I don't want any of their extra services. We'll just skip that. I don't need the graphics, but obviously they're saying I can get through this in 45 minutes. We're not going to spend that kind of time. Okay, so this is obviously not my name, not when I was born, not my social. Put down I'm a student, yada yada. Just filling out the forms. You can use your own data if you like, but I wasn't a student. Marital status, claiming single. And it'll go through and tell you, because sometimes there can be people that can qualify. If you're taking care of an elder, that can, if you've adopted, if you've got whatever situation, it's smart enough to know. I'm just gonna, nobody. It can do your state taxes as well, not an issue up here. Okay, so again, all this stuff would be imported from the previous year. So again, we're kind of saving some time. Some of the numbers are staying the same. If it's the same employer, all those things are good. There's an auto import feature. Again, this isn't unique to TurboTax. A lot of these services have got this. Okay, so let's talk about income. I'm going to go ahead and put that I made $100,000 just to keep the numbers easy. Now it would import from ADP if that's how it worked. Okay, I guess they want something in there. They probably don't want that though. How about that? I may have to pause this thing if it doesn't let me go any further. Fair enough. Type it in myself. So it would import this stuff for you. This is where my $100,000 is going to come in. The amounts withheld. There is going to be withholding, which is going to be an estimate, right? I'm going to put in $15,000. And what was that? About 6% or so. And Social Security wages should be about the same. These numbers will vary. We're not going to get down on the minutia. We could explain how these numbers are arrived at, but we just want enough numbers to make it realistic. So we're going to start seeing a amount that's due in terms of taxes, which is what we're trying to get at. We didn't have any of these situations, but again, all these questions, these are things that you'd have to kind of nug through if you're doing the paper form. Now it's going to look at the tax table, so it's going to look at what kind of deductions you did, and then it's going to start to calculate a tax. Did you win any money? Because a lot of times people forget to claim that 1099. When you are given a tax document, it's provided to you and it's also provided to the IRS. So they're going to figure it out. 1099Ks, a lot of people are doing kind of gig work or different kinds of work. 1099 NECs, 1099s, I issue 1099s. Anyway, if you do something for more than $600, which is kind of odd because they talk about only trying to increase taxes on people making $400,000 a year. Anyway, they're down in the weeds to track those people. Foreign account, I'm going to put no. But the deal with a foreign account is you need to have more than $10,000 in there. So if you're smart, you don't do that so that you don't have those problems. So far, based upon that $15,000 I said I paid and my $100,000 income, I'm going to get $700 back, which means that $15,000 was close, but a bit of an overestimate on my part in terms of the amount of money that was necessary. Now, what I want to do is I want to go through. I don't want to buy any more of their services. It's up to you, but I want to go through and start calculating to see what impacts like home ownership and things like that will have, charitable deductions. It's asking about disasters, digital assets. Crypto is a big thing. The people trade crypto on different exchanges. Now the refund is actually starting to pick up here in the corner. So tax breaks. Again, pretty user friendly, pretty sorted out here where It's going to ask about the standard deduction, remember, and then itemizing. Standard means you take the government amount. Itemizing means you itemize with the goal of trying to, do more. So it's going to ask a couple key questions. One of the big items is this mortgage interest. And yeah, for most people, you're going to pay more than $7,200. How much are you paying property taxes? If you live in the borough, Anchorage borough, you paid more than $5,000. Car registration fees, you paid some, right? Donate to charity, you're not that much of a tightwad. How much you spend in medical expenses? Probably not more than $7,500 unreimbursed. I'll put 1 to 75. Now it's going to look and do kind of a quick calculation and go, we're getting a solid idea. So it gives you these little, it's very whatever. It's set up for people who don't want to do their taxes. Okay, so Goodwill, it knows that I gave money to Goodwill or gave items to Goodwill last year. I didn't make any estimated tax passes. Health savings account, no, I didn't do one of those. Home buyer credit, no. Spend school expenses as a teacher, let's say no for this case. Contribute to an IRA, let's say no. Most of the time you did. Charitable contribution, did it exceed some limits? No, let's just make this going away. Nope. Nope. Okay. So it's just trying to quantify things. So now we're able to actually start making some decisions here. Let's say I want to rent a home and I'm going to pay $1,800 a month in rent. Or conversely, I can spend, say, a couple grand a month and buy. How does that compare financially? Am I in better shape to do one over the other? First off, home ownership, there's more involved. You may enjoy the home more, but you're probably going to spend more because you're paying for maintenance, you're buying stuff, but maybe your quality of life's substantially better. Maybe you can have pets, maybe you can do things like that. There may be all sorts of other factors that may drive you to buy rather than rent. But anyway, that's how that works. In this case, yes, I'm going to pay a home loan because I've decided I want to explore and see what's going to happen. Now, keep in mind, your landlord you're paying rent to, he's deducting these items, but since you're the renter, you don't see those benefits. It wants to auto import. I'm not doing that. So bring it over, upload 1098. So it wants the form. I'm just going to type it in myself because we're just looking at examples. So Wells Fargo, whoever, Freedom Mortgage, somebody like that. None of these apply. Mortgage interest. So, like I say, you buy a home, you're probably going to be paying, that's not an unreasonable amount, about $11,000 worth of mortgage. If, say, you're, well, it's probably even going to be higher. Let's go with 15. Because if, say, your total mortgage payments were around $24,000 throughout the year, $2,000 a month, some of that is taxes, some of that is insurance, the principal. Anyway, we're just going to put $15,000 in there that was paid. Yeah, $280, something like that. Insurance premiums. This is insurance on the actual mortgage itself because you didn't have the down payment. We're going to say 0. And property real estate taxes. Oof. Again, probably around $9,000, something like that on a house like that. Continue. Yeah, what's a date? 1/1/2003. Just trying to make the numbers go away. Nope. Huh? Why can't I claim the mortgage interest? So, secured loans. Whoops. Okay, so I got to go back and fix the answer to that question. Yes, secured. Okay, yeah, my bad. I jumped right through this, not paying attention. Obviously, the collateral for this home is the home itself. So it's secured by the property I own. We'll talk about loans later, but loans that are collateralized, loans that have some recourse for the lender, they have an asset tied to them. In this case, okay, see what happened? It went from $734 that I was going to get back to damn near $3,000. Okay, so a renter would not get that money. A renter would have to, he would be foregoing a considerable chunk of money. So it's not perfect. You're not getting all of your money back. It's just the tax deduction. But you can see where home ownership just, helped this person out by about $2,200. So that's one of the benefits. There's a lot of moving parts to home ownership, but that is one way that the tax code is written. So that's kind of what I wanted to show there. Let's go to another category. And see, this is kind of, you can sort of jump around and look at all the different tax breaks and maybe go, yeah, I probably, in my case, my basement it needs some insulation. There's probably a tax credit program that can help me out with that. Education, what things are deductible. If you're counting on deducting something, thinking, well, that student loan interest, that's deductible. Are you sure? Run the numbers and double check. Charitable donations. I'm going to jump into this real quick. What we're going to look at is this whole notion of tax deductibility. So goodwill, this is just the carryover from the previous year. I'm going to go ahead and put an amount in here. Yeah, clothes and furniture. Oof. How do you value them? They have something to kind of guide you, or I'll just go ahead and guide myself. So the important issue here is that it has to be within the 2023 tax year, right? If this number was 2022, it's going to give you an error and say, yeah, you can't. But because I was one day into the new year, things are tax deductible. The other thing about this is when I save this whole thing printed out, I will have a record. So when I'm audited, whatever number of years down the road, actually they call them examinations now, but when that happens, I will have some sort of record. Make sure, if you're claiming things like this, that you have some sort of plausible, legitimate, maybe a picture, maybe a receipt from the thrift store or whatever, but something. There are household items, description. I wouldn't want to put junk. No, that would not be good. That's not going to help me out. I want to put valuable. I don't know, just something. But something that more itemization would be better. But maybe a picture and something like that would be helpful. How did I come up with this value? They don't have, pulled it out of my... No, they have replacement cotton. That's probably not going to work. Consignment shop value, because that's what they're going to do with it. Goodwill is consignment shop, right? Boom. So I gave him $1,000. Look what happened. I get another benefit there. Now, I donated $1,000. Did my taxes go down by $1,000? Did I get $1,000 more on my refund? No, it was tax deductible. I only got that portion based upon my tax deductibility. Anyway, I think we've kind of explored taxes enough. My throat is going quickly. So that's kind of it. Again, on the homework, don't stress over the homework. We got some time. You have up until the midterm to get that done. I'm not saying not to keep up with it, but again, it's not something that needs to be turned in weekly. Sounds good.